Have you guys ever heard of a condo deconversion? Well, in this video, we're going to teach you everything you need to know about this new investment strategy out in Alberta. What's going on, guys? Josh and Aaron back for another Finance Friday, and in today's episode we are going to dig into a strategy that we actually haven't talked about on this channel before. It is called the deconversion. So it's probably what you're thinking, but it's a pretty unique investment strategy. It only works in certain areas in the country, and it's quite profitable if you can execute at a high level. So let's get right into it. What is a deconversion? Well, a deconversion kind of stems back from, going to a place where you have low rent per unit. So predominantly we see this in Alberta, in places that have low cost per unit. And what the strategy is acquiring all of the units inside of an entire building and then creating a single building out of it, deconverting the actual condo corporation, meaning dissolving the condo corporation, creating a single title, and then renting that entire building out at market rent, and the value between what you acquire the building on a per unit basis for versus what it's worth at a cap rate at full market rent, you're making the profit in between that. It can be extremely lucrative, but also extremely difficult to execute because you have to close every single unit individually.
Yeah, I think that's the biggest piece there is that, you're not going to be able to offset the closing dates on here. I mean, maybe if the lender is willing to be somewhat flexible, but I mean, realistically, they're going to want to advance one loan, across the entire building. So you're going to have 15, 20, 30, these closings all on the same day. Definitely going to be a lot of seller management going on there, right? Just making sure that everyone's on board, making sure they understand the timings, making sure that, they understand that their closing might depend on the neighbor's closing as well too, right? So from what's going to be the most difficult part of this, it's going to be the management. The rest of it is, again, falls into pretty simple financing once you get through that first part of it and you're able to get them all locked up. But yeah, just be prepared to manage the building.
Yeah, the intricacies behind it all are also quite challenging because a lender, especially a commercial lender, is only going to finance the building if you have all of the units locked up. So you have firm purchase agreements on all of them. There are some logistics around actually getting them all under contract, and then you're offering contracts to people in a building, and if one person thinks they can get more because they're holding up the transaction, obviously somebody could hold you a ransom. We've seen that a few times where we get to closing and they're in the middle of closing and somebody now wants more money to be able to hold up closing. So it is quite a delicate process to close. Not a lot of lenders actually have the capability or want to close, but the value difference between them, for numbers sake, you can purchase a 1-bedroom unit and a 3-story walk-up in Edmonton. You used to be able to purchase them for $65,000, $70,000. We've seen some people execute these trades at acquiring for $100,000 per unit. And in Alberta, if you guys are buying in Edmonton a building at $100,000 a unit, you're still getting a smoking deal. So being able to acquire them even above market allows you to be able to you pay more on a per unit basis to each individual person to be able to lock up the property, because realistically, if they were to sell it on the open market, they would be getting 30% or 40% less than what you're offering them right now. There's an arbitrage play happening, and I don't know if it's going to last for long as you're starting to see cost per unit go up across the board in Alberta. It's been something that's been quite lucrative, but very difficult to do. There are some groups out there that specifically focus on doing this, where you can either wholesale it from them and buy it from them with a bow on it, or you can go out yourself and do it. It does take quite a bit of time, obviously, to negotiate. It's very active, almost like a investment active business, but we have seen a handful of even conventional lenders get into lending on these, at least on the bridge financing. Some things to consider when you're looking to acquire this is you're going to probably have massive levels of vacancy right off the bat. The majority of people who are going to be selling their properties live in it. It's their home. So you're probably going to have 80%, 90% vacancy, which if you're looking to execute, it's probably a good thing. You got the vacancy, you can go in right away, you can do all your renovations, you can upgrade all the units, interiors, exteriors. The idea here is to then dissolve the condo corporation. Now, usually the condo corps, because they have condo fees coming in, there's money inside that condo corp. So because you own all the units, you get all the money inside the condo corp too. So sometimes there can be $80,000, $150,000 in there, can go towards helping with renovations and whatnot. But you guys get that, on closing. And then when it comes to actually executing, it's just a matter of doing the same thing as a BRRRR. Once you have the vacancy, going in, renovating, and then leasing them out at market. Doing this there are a ton of 3-story walk-up multifamily buildings in Edmonton to do this with. That gap between what you can buy it for and what market on a per unit basis, a good deal is slowly shrinking. But we've seen this actually executed a handful of times throughout the city.
Yeah, and I mean the next biggest value add there is simply just the turnover in tenants. Obviously, the vacancy play is huge, but also just the understanding of how that building is now going to be valued, where you're taking a bunch of condos in a relatively dead market, going based off what you're getting on a cost comparison approach to other buildings in the area, other individual condo units in the area to be specific. And then when you refinance this back out on your CMHC, commercial term debt, whatever it is, now you're applying a cap rate to that NOI that you've essentially gone from vacant units to top tier market rent, and the value increase is huge. I mean, you can get double to triple the cost per door what you purchase it at just by going through that cap rate, right? So I mean, when you're going from that standpoint and you're taking a look at the equity that you've built in this, if you can pull it off, especially if you're going to get the vacancies in there, it makes a lot of sense. Like Josh said, there's a lot of work that goes into it. It's being able to find buildings that you can get the individual units at a good price, because that's obviously going to be a kicker. Dealing with the tenants, all that stuff, it's definitely not the easiest project in the world, but for some of those guys that like to get a little bit creative and have the capital to get it done and the time and the patience and kind of see that project to the end, the upside is massive.
Yeah, touching on capital, it's a good point. It is quite a capital intensive investment. So when you are looking to acquire one of these, if you're trying to go conventional lenders are no longer allowing you to finance the assignment fees. So depending on the size and scope of the project, if you have somebody who's doing this for you, providing you the contracts, the assignment fee would have to be paid out of pocket. Then you're probably at least 25% down. Odds are you're going to have a sub 1 debt servicing, meaning your mass levels of vacancy aren't going to be able to support the debt servicing needed to take on the loan. So you're probably at least 6 months, maybe even 12 months, depending on the term length you're taking on for an IR. What that means is you're prepaying your interest for 6 to 12 months, depending on the length of term you take. So if you factor in your down payment, your fees, your carrying cost, and then your renovation equity to be able to actually do this, it can be quite a significant amount of capital up front to be able to execute on this. So I would say even more than a BRRRR, and probably even more than construction financing. So if you are going to looking to get into this, just realize that there isn't really a way to be able to do this without being very well capitalized.
Yeah, wholesale fees, obviously one of the fees that's going to be involved here. Obviously you're going to have some legal work as well, the lawyers, dissolving the corp. So I mean, again, just talk to probably a lawyer that's well versed in condominiums and just understands everything that's involved in condo corps, condominiums, the laws, everything like that. Obviously you want to make sure you don't have any hiccups or issues moving through it. Legal time and a cost per dollar is not very cheap, so just making sure your efficiency there. But again, like Josh said, it's having the liquidity here to get this done. It's going to be paramount to have a smooth and efficient finish.
Yeah, I mean, touching on legal fees, so you are closing, let's say you're closing a 25 unit building, you're closing 25 transactions. It's not one apartment building closing. You have 25 sets of legal documents, 25 deposits. The legal fee to actually close one of these is quite significant in comparison to just closing a regular multifamily transaction. So it's something that definitely to keep in mind, because your costs, expenses will go up. But one of the advantages is most of these buildings are actually individually metered, though, because they have individual condos. Each person is responsible for their own utility costs. So when you're looking at the efficiencies of the building from an operation perspective, there's kind of an added advantage there.
Takeout financing wise, the idea here, obviously going to CMHC on the term debt. Again, in Alberta, using affordable rents, it's pretty attractive. It's pretty competitive. 1668 is a pretty good number in most markets to be hitting the top tier market rent. So exiting into CMHC, again, the goal here would be to get the new loan to value and not necessarily what you purchased it at. Now there's gonna be a few things that kind of play into the ability to get full loan to value and not maybe a slightly different underwriting structure with CMHC. If you can get full vacancies on the purchase, probably going to give you a better likelihood of CMHC allowing you to have full loan to value versus if the tenants stay and it comes across as you're kicking those tenants out, CMHC is probably less likely to give you full loan to value and more based off of like a purchase plus cost approach here. So obviously best case scenario, when you go to refinance, you're getting up to 95% of that new value, again, based on the cap rate. So it's nice and juicy. Worst case scenario, you go through a refinance, you're getting your purchase plus cost done. And then once the building's stabilized for 12 months, you go back to CMHC, you can get a secondary pari passu mortgage, pull out the remaining equity there. But again, like the goal here, depending on how the tenant situation is structured and the underwriter at CMHC too, I suppose, trying to get 95% on the refinance in one swoop.
Yeah, I mean, the strategy is one that's quite unique to just really Alberta. I'm sure it happens in other provinces that have like a low cost per unit basis, but I guess the moral of the story here is there's still lots of people executing on unique investment opportunities in the country. You have rental growth in some areas. You have the ability to be able to still use these phenomenal products to be able to execute on your strategy. There's still lots of people who are looking to make offers in this market. People who are looking to do this. It does just take, again, a little bit of time and effort to be able to make that happen. If you do have any questions about this specific strategy, or you want to know more about how you go about doing this, or get in touch with people who can put these deals together for you, feel free to reach out to Aaron and myself. We're happy to walk you through how this works. If you did like this video today, please hit the subscribe button, hit the like button. It allows us to make more content like this for you. We really appreciate you guys watching today, and we'll see you next time.